Greetings from MWN.com. Dr.M.Wilson, formerly Vice Principal and Head of Department of Commerce, Scott Christian College, Nagercoil is delighted in presenting this session. Thank you. Please subscribe the channel MWN.com. Determination of factor price. Cost of production reflects all the costs that a business pays with respect to manufacturing a product or providing a service. The factors of production are land, labor, capital, and entrepreneurship. Factors of production, overview and characteristics. Factor cost. Factor cost is the total cost of producing goods or services, including payments for land, labor, capital, and entrepreneurship. The price of a factor of production is determined by the intersection of the supply and demand curves for that factor. The price of a factor will rise if demand for it exceeds supply, and fall if supply exceeds demand. The factors of production, like land, labor, capital, and entrepreneurship, are well presented in this diagram. Supply and demand of factor cost. In economics, factor prices are determined by the intersection of supply and demand curves for a factor of production. When demand for a factor of production is higher than its supply, the price of the factor will increase. When supply is higher than demand, the price will decrease. In this diagram, demand curve and supply curve are well presented. X-axis represents quantity of factors and Y-axis represents cost of factors. Both curves intersects at one point which is known as equilibrium point, and the quantity of factors and price of factors are normally determined at this point. When the company expands, then the demand for factors increase, which is shown in the second demand curve. This diagram shows that supply and price of some factors remains same for certain period, whatever may be the change in quantity demanded. Importance of factor prices. 1. Impact production costs. Higher factor prices increase production costs, which can lead to inflation if businesses pass the costs on to consumers. 2. Reflect productivity. In a competitive market, factor prices tend to reflect a factor's marginal productivity. This means that more productive factors command higher prices. The formula for calculating factor pricing is as follows. Price equals material costs plus labor costs plus fixed overhead into 1 plus profit margin. Determination of factor price. The factor prices of the factors like land, labor, capital, and entrepreneurship are as follows. 1. Cost of land. Land is a factor of production, includes the natural resources used to create a good or service. These can be renewable resources like forests or non-renewable resources like oil, gold, or water. Land provides the physical space and natural resources necessary for various types of production. It includes the soil for agriculture, forests for wood and paper products, minerals for mining, and water sources for energy generation and agriculture. The cost of land generally means is rent. The cost of land for production is the rent paid to use a piece of land for production purposes. Entrepreneurs sometimes own the land. For construction of buildings, finance is needed. It may be contributed by the owners and also borrowed from financial institutions. The cost of the capital by owners and the interest paid for such loan may also be considered as the factor cost of land. Land is considered a resource with no cost of production because it is a factor in production but is not consumed during the production process. 2. Labor cost. Labor cost is known as wages. In broader sense, it is called wages and salary. Labor as a factor of production includes all employees working for production of goods and provision of services. The employees at the bottom level are known as workers. The payment for them is known as wages. They may also be known as direct labor, and the cost involved is known as indirect labor cost. But the payment to middle level and high level employees is normally known as salary. Otherwise, it may be known as indirect labor cost or labor overhead. The price of labor, or wage rate, is determined by the supply and demand of labor in the labor market. Determinants of labor cost. 1. Demand of labor. The quantity of labor demanded by employers decreases with higher wages, and increases with lower wages. 2. Supply of labor. The quantity of labor supplied increases with higher wages, and decreases with lower wages. The equilibrium wage rate is the rate at which demand and supply are equal. 3. Marginal product of labor, M.Phil. The value of the marginal product of labor determines the demand for labor. Marginal product of labor, M.Phil, is the increase in a company's output when it hires an additional unit of labor, while other production factors remain the same. It's a key metric for businesses to understand how adding more employees will impact productivity. M.Phil is the ratio of the change in output to the change in the quantity of labor. M.Phil is usually positive when a company first hires workers, but it will eventually slow down and become negative. This is because as more workers are hired, they have to share resources like equipment, which can decrease production. This is known as the law of diminishing marginal returns. Businesses can use M.Phil to help guide strategic decisions about resource allocation, including labor, equipment, and capital. 4. Government intervention. The intervention of government may be like, by setting a minimum wage, increasing demand for workers, or subsidizing wages. 5. Regulations. Government in many countries heavily regulate the labor market in the form of maximum daily or weekly working hours, holidays, wages, and other benefits. 3. Capital cost. Capital is classified as fixed capital and working capital. Fixed capital costs for production are normally one-time expenses incurred to acquire, construct, or enhance assets that are used to produce goods or services. These assets include buildings, equipment, land, patents, and technology. Working capital costs are also known as operating expenses, which are recurring costs for labor, materials, and energy. The cost of capital is a measure of the cost a business incurs to finance its operations. It is from own capital and borrowed capital. The cost of own capital is the rate of return from investment after paying interest. Borrowed capital is in the form of debenture and loan, and the cost of it is known as interest. The concerns are expecting a good return on overall capital to service the debt and keep the remaining portion of the return for the owners. Entrepreneurship cost. The profit derived from the entrepreneur's investment of ideas to run the organization is known as entrepreneurship cost. It is the amount of profit after payment to interest and tax. This remaining profit may be given to owners in the form of dividend after making statutory reserve and other reserves as the company wish for meeting the future contingencies. The cost of production for an entrepreneur is the total expenses incurred to produce goods or services, including the cost of the entrepreneur as a factor of production. The cost of production for an entrepreneur includes direct cost and indirect cost. Costs directly related to the product, such as raw materials, labor, and consumables, are called direct cost. Costs related to running the company other than the direct cost, such as maintenance and overhead,